Hello, everyone, and welcome to another session of the Metals Investor Forum. We're so glad to have you here today. It's an exciting time to be talking about metals and stocks and opportunities. I often, when I'm presenting at the Metals Investor Forum, I go to a recent presentation that I gave maybe a few weeks ago, and I update a few slides, to make it current. I had to rewrite the book this time. I had to sort of write a whole new presentation because I think so much has changed in the last few weeks that I rewrote a whole presentation. And so without further ado, I'm going to jump right into it. And you can see here, a really complicated title slide here. Is this it? Yes, it is. So this is what I think is going on here, which is that, we've had some pretty exciting price moves across the board in the commodities complex over the last, 6 months, few weeks for gold. And I keep getting the question, is this it? Is this real? Is it actually happening? And I think that it truly is. So I'm going to go through the reasons that I think that's the case, sort of from top to bottom. Those of you who are watching this are probably quite familiar with the fact that the commodities complex is rising. I mean, if you use the JSCI Commodities Index, it was up 23% in the first 4 months of the year. That's a dramatic gain. Yes, as you can see from the chart, that only means that it's recovered to pre-COVID levels, but it's still a very significant ascent. Look at the pace of that ascent. So then the question is, like I say, can it last? So let's go through sort of the fundamentals of that question, the technical picture for that question, and what historical patterns say to try and understand the opportunity from here. Okay, so if we want to start with fundamentals, we're talking about commodities here, and almost across the board, the answer to that is the fundamental picture is good, right? In general, metals are looking at strong demand and, just enough to insufficient supply. Depends which metal you're focusing on, but in general, we have strong demand against weak supply. And that's why the copper price has done what it's done in the last year. What a phenomenal price move. I mean, nickel took a bit of a setback in late February or March. I can't remember when exactly it happened. There was this strange announcement out of China about the ability to turn the bulk kind of nickel that we have that can't usually be made into high-grade nickel. The market overreacted to that because I don't think that process is actually coming to the fore anytime soon. But now the price is recovering and returning to its ascent pattern. And the reason is because demand is strong and supply is weak. And that's what the charts on the right side there show. For copper, for nickel, I just threw two others in here. We have palladium. I mean, the palladium price has been on a tear for quite a few years now, but it's because palladium has been in a deficit for almost a decade, and that's not actually changing anytime soon. So, we remain optimistic on palladium. Look at what iron ore has been doing. Commodities are on a tear. I'm not saying that any of them are going to continue going only upward. That would be a silly thing to promise. But the big picture is that there's strong demand and there's weak supply. Okay, so then let's look at the technicals side. So what are the charts telling us about some of these price points? In general, I would say the short term, as usual, is mixed. I mean, right now, the short-term technical chart for copper is a bit bearish. Well, that's not super surprising given the run that it has gone on in the last month. Setbacks, consolidations are quite normal for that. So you can see, if you want to get into this, you can see that copper crossed below some of its moving averages and some of the momentum indicators are down. But what's important to see in a technicals picture here is that even if it does break down below some of the key point that matters right now, which is 465, there's a bunch of levels of good support that are not far below. That's what happens in a strongly bullish environment. You get lots of support. So even if it falls a bit, there's a stopper here and a stopper here and a stopper here. And so that helps drops to get supported and turn around again. And at the same time, when momentum is so strongly bullish, you get situations like we have right now where if copper bounces back up past about 470, well, the technicals picture is clear sailing to 482. So it's a bit bearish in the near term for copper. But the medium to long-term trends on all of these, because of the momentum that's been established now for many, many months, are solidly bullish. These are a few more technical charts, not as technical as that last one. You can see that, gold breaking up through its long-term downtrend that was established, since August of last year, was a really significant move that happened back at the beginning of May. This chart is a few days out of date, maybe even a week out of date. It is now back up through that 200-day moving average, another strong sign. You can see, just like with copper, there's good supports at multiple levels, not too far below. Silver also looking good on a pattern basis. You can see it is now doing its third test of that strong resistance level, and looks likely to break up through it. So the technical side of things, obviously that's only a few charts, but the technicals side of things also looks supportive. Even if it's bearish in the near term, it looks supportive if you take just a small step back. Then what about history? I mean, a 23% gain in the commodities complex in 4 months, is that sustainable? Is that something that can carry on? Well, the Canaccord did a great assessment just recently where they looked at years where commodities did put in strong performances in those first 4 months of the year. Well, what did they then do for the rest of the year? They isolated the top 10 performances. They cut out 2008 and 1982 because we don't expect there to be another recession this year. So let's get rid of those outliers. And the pattern suggests, it's simplified in this bottom chart there, that they take a little bit of a breather through the summer and then carry on upward, gaining another 9% over the rest of the year. So, I mean, we can't assume that past patterns will be repeated, but we look at patterns because they are what they say. They're patterns, so they do matter, and precedent has been set. Okay, so those are some of the bigger picture things. In the moment, we certainly, a key story right now is gold, right? I mean, this is the this is a 2-month chart, I guess, 60-day chart of gold. I mean, that's a move, right? Just a month ago, we had gold at 1740, and now we're talking about gold at 1870. That's a very significant move. A month ago, 1870 seemed like a distant dream, and now it's here. This is the world that we're living in, which is lovely. What's interesting, putting that into the commodities context, gold, of course, underperformed commodities through this cycle so far. When commodities gained 23% in the first 4 months of the year, gold did not participate in that party. It was very slow. But gold does tend to participate in broad commodity bull markets. So there were a bunch of reasons having to do with certainty around inflation, which is the next thing I'm going to dive into, that I think held gold back for a while. Bitcoin also held gold back, and that situation has also changed to some extent in the last few weeks. But I think with some certainty around inflation and with Bitcoin crashing, gold is now catching up and will likely just join into this commodities party that we're having. So that is another, optimistic perspective. And of course, the real reason that gold is performing right now isn't just because it likes to hang out with other metals. The reason that it responds to inflation talk is because negative real rates are the most important bull force for gold. I put some version of this slide in almost every talk. I changed the details, but this is the 10-year Treasury inflation index. So this is a good proxy for the 10-year real rate. And it just shows what's been going on. So the gold market started back in 2016 when rates fell sharply. I kind of cut the chart out a little bit there, but rates had been tanking down into the first part of the chart. Then from mid 2016 through to mid 2018, rebounding real rates hindered the gold market. Gold was getting going again because real rates were declining again as we got through 2019, and then bam, COVID hit. Central banks slammed interest rates to zero. Suddenly, real rates became very negative and are going to stay there. That matters because, as this chart in the lower corner shows, gold, which is inverted on this chart, and the real yield on the 10-year, I mean, that is what I call correlation. They love each other. They hang out all the time. They hold hands. So if we expect real rates to remain negative or declining, then that means we expect gold to remain high and perhaps climbing. So then the question becomes, what is ahead for real rates? That is the question that matters when it comes to gold. I am certainly in the camp that believes the Federal Reserve will not raise interest rates soon. I think in their minutes yesterday, they said they put so many qualifiers on the thought that they might consider at some point in the future thinking about raising rates. They put so many qualifiers on there it didn't matter to me that comment was in there. They had to say that at some, they're not going to keep rates at zero forever. But they're not going to raise rates anytime soon. That's not, especially with unemployment where it is, and growth not still lagging to some extent. So if the Fed is not going to raise rates, the question becomes, what is ahead for inflation? I warned you that I was going to get to the inflation question, and now I'm going to linger on it for just a moment. So inflation is certainly here. We saw that in the CPI numbers that came out last week, where we, the month over month CPI inflation was expected to come in at 0.2%, and it came in at 0.8%. That's a bit of a difference. That was one of the things that really fired gold up. The Federal Reserve and those who don't think inflation is going to stick around, they think that this is all transitory, that it's because of base effects. So inflation now relative to a year ago isn't a significant number because things were so messed up a year ago. Fair enough. But the 0.2 versus 0.8 inflation that 0.2% expected versus 0.8% real inflation that I just mentioned, that was month over month. That wasn't year over year. So that's not a base effect. That's inflation that's happening month over month right now. So the Fed is sticking with this concept that inflation will be transitory. But I think, and there's a laundry list of reasons to believe that inflation will stick. I mean, the COVID-based supply chain disruptions, I think, are going to be around for a while. Transportation costs have gone through the roof. Anybody trying to build a deck these days, let alone build a house? I mean, this image beside says, what will $50,000 worth of lumber build you? Well, in a year ago, it would build you 10 houses. Now it'll build you 2. That's how much lumber prices have gone up. So inflation is very real. And then, of course, there's the ongoing massive fiscal spending, the explosion in money supply. And like I say, inflation is clearly here. There's that month over month, knock it out of the water result that we saw just last week. Some other things, in a recent survey, a third of U.S. small business owners raised prices in April, which was the highest response in that survey in 40 years. Inflation is here, it's rising, and I think that there's a lot of signals that there's more ahead. I would put the caveat in that wages have not yet gone up, and that is a risk factor in the inflation question. But I think wage inflation is the next thing that we will see. And here's another interesting chart that I saw from Scotiabank. So this is a scatter chart of the correlation between inflation and gold and the level of inflation. So the x-axis is how much inflation are we seeing, and the y-axis is how correlated is that inflation to gold. And what you can see is that when inflation is muted, so when it is less than 3%, there's almost no correlation. So gold and inflation will do whatever they want, and they're not particularly correlated. Once inflation gets above 3%, gold and inflation get very correlated. And why is that? Because negative real rates are what matter for gold, and negative real rates are primarily determined, especially in this environment where I don't think the Fed is going to raise rates, it's determined by inflation. So about those real rates, if I do think that inflation is here to stay, and that the Fed is not going to raise rates anytime soon, what what are we looking at here? The real rate that matters is the one that I charted multiple slides ago, which is sort of the real rate on the 10-year Treasury. This is a chart of just the nominal 10-year Treasury yield. It went through a ramp from sort of the fall of last year until March or April, where it went from, like 0.6% to 1.6%. That certainly hindered the gold market. It does seem to have stabilized from here. Is it going to rise some more? I think it's possible for sure. If US economic growth remains and we get inflation, will yields rise when there's inflation? Massive deficits also just mean that there's an abundance of notes, and when there's a lot of supply of notes, then the price of notes goes down and the yields go up. So I think there is reason to believe that the 10-year Treasury yield will go on another move up, 2.3, 2.2, 2.1. Lots of analysts say that it's probably going to sit in that range sometime not too long from here. The Fed is being a little sneaky and is doing a bit of an operation twist to keep longer term rates down relative to short term. They've only talked about it in a little bit here and there. It's like the first step towards yield curve control. So they're like careful about stepping into those waters, but they are doing it to some extent. But what matters is that even if the 10-year yield rises to 2%, if we have inflation at 3%, 3.5%, whatever it might be, real rates are going to stay negative. And what do negative real rates mean for gold? I showed the correlation previously when I said that they love each other and they never let go. I mean, the upper chart here is that again, it's gold versus the US real 10-year yield. They track each other very closely. Obviously, the yield spiking there is because of the recent inflation print, and gold is only just working to catch up to that. And then there's the bottom chart is Canaccord talking about where that trend line takes us. And their forecast, which is similar to the numbers that I've been outlining here, is that, if we do get the 10-year yielding 2%, but we have 3 or 3.5% inflation, that's a real yield of negative 1.5%. And that's where that arrow points. Does that put gold at $2,100 an ounce? Well, it would if that trend line continues. And there's lots of reason to believe that it would. So that's the picture for gold. That's sort of the technical and fundamental picture for metals, obviously going very quickly. The other aspect of this market, though, is I do feel like of late, there's been all of this excitement for me around metal prices, and I see lots of stocks that are interesting, especially because we're like sort of on the edge of this exploration season. But yet there's been a little bit of a lack of excitement on the retail front. It's not bubbly by any means. If anything, we're still sort of having to look for investors. I think that requires just a little bit of context. I mean, gold always has its naysayers. Is it just a barbaric relic? The broad markets have been handing out money for years. Tech stocks and crypto, they're the definition of splash. Commodities until recently haven't performed as a group. Maybe one went or another didn't, and then they stepped back. So they didn't gel and stand out. It's been hard until now, I think, for metals to attract attention. But as of this point, I really think we have a multi-metal bull market that is fueled by electrification and green energy, inflation, growth, negative real rates, and on top of that, mining companies standing out across equities for their balance sheets and for their dividends. When you have a multi-metal market with this many levels of support, that's the kind of market that builds momentum. And momentum matters because it feeds into itself. This is just an example of what I was saying, miners standing out across equities for their balance sheets. This is on the top left is Dividend. I added in, this chart is a few months old, and so I've added in the new levels for the red line, which I've extended in yellow there, is the gold producer average dividend yield for majors, 2.3%, the S&P 500, 1.4 and falling. And the 2.3 is going to keep rising. They stand out. They have money in the bank. They're handing out cash. It's amazing. And then the senior golds are trading at a 15% discount to gold. During the last bull market, they traded at a 40 to 240% premium. Miners make fundamental sense from just a cash flow basis and they offer upside if you believe any of what I was saying about strong demand, weak supply, negative real rates, and all of those forces. So I do believe we're in a major metals bull market. It's here. Corrections happen, nothing goes up properly, but I think all of the forces are in play. Gold required a little bit of patience. It required actually less than I thought. I thought we might have had to wait until later in the summer, but it looks like the gold market sort of showed up. And we'll see what the summer does. I think pay attention to your exploration stocks. That's obviously the area that is most exciting during the summer of the Northern Hemisphere. But I think that we're here to have some fun, and that's pretty darn exciting for me.